Understanding Penny Stocks, a comprehensive guide. Penny stocks have garnered a reputation as a high-stakes investment category, attracting both seasoned and novice investors with their promise of high returns. However, navigating the world of penny stocks requires a thorough understanding of their structure, potential for growth, and associated risks. What are penny stocks? A penny stock generally refers to the stock of a small company that trades for less than $5 per share. Historically, the definition included stocks trading for under $1. However, the U.S. Securities and Exchange Commission, SEC, broadened this to encompass all shares costing less than $5. Most penny stocks are traded through the over-the-counter, OTC, market, specifically via the OTC Bulletin Board, OTCBB, or OTC Markets Group. Unlike major exchanges such as the New York Stock Exchange, NYSE, or NASDAQ, OTC transactions do not occur on a physical trading floor and are conducted electronically. Key characteristics of penny stocks. Low trading price, typically priced under $5, they often represent small, developing businesses. Search for funding. Many penny stocks are associated with companies looking for public investment to finance their growth plans. High volatility. Due to their low trading volumes and market capitalization, penny stocks tend to experience significant price fluctuations. Speculative nature. With high potential returns comes substantial risk, making penny stocks more speculative compared to established equities. Why do investors buy penny stocks? Investors are drawn to penny stocks for several reasons. 1. Potential for high returns. While the risks are substantial, penny stocks can yield high returns in a short period. Some organizations that start as penny stocks have escalated into blue-chip stocks, providing early investors with impressive rewards. Companies like Amazon (AMZN) began as small stocks, prospering into some of the largest corporations globally. 2. Investment accessibility. For many investors, the low share price provides an opportunity to buy large quantities of shares without significant capital investment. This accessibility attracts individuals looking for affordable investment options. 3. Market entry for small firms. Small companies utilize penny stock offerings to access the public market, often as a stepping stone toward listing on larger exchanges. This can allow upcoming businesses to gather the capital necessary for growth and expansion. Risks associated with penny stocks. Despite their allure, penny stocks present numerous risks, making them unsuitable for all investors. 1. Lack of transparency. Many penny stocks lack the necessary regulatory scrutiny, especially those trading on the pink sheets, which do not require regular SEC filings. This absence of information can obscure details regarding financial performance and company operations, complicating informed decision-making for investors. 2. High rate of failure. The majority of small businesses, and consequently their penny stocks, fail to succeed. Investors often face the risk of complete loss, as many companies do not develop as hoped or eventually declare bankruptcy. 3. Low liquidity. Due to limited trading activity in the small size of many companies, penny stocks often have low liquidity. This means investors may struggle to sell shares at their desired price, leading to forced sales at substantial losses. 4. Manipulation and fraud. The low trading volumes associated with penny stocks make them susceptible to stock price manipulation. Schemes such as pump and dump, where unscrupulous operators artificially inflate the stock price before selling off their shares, can lead to significant losses for unsuspecting investors. Tips for investing in penny stocks. To navigate the volatile landscape of penny stocks successfully, investors can implement several strategies. 1. Conduct thorough research. Before investing, due diligence is paramount. Check financial statements, market trends, and corporate strategies. Information is essential for making informed decisions in a high-risk environment. 2. Use reputable brokers. Leverage the expertise of established brokers who can provide legitimate information and resources. Avoid undertaking transactions based purely on unsolicited tips or dubious promotional material. 3. Set limits. Establish stop-loss orders before entering trades to cap potential losses. Additionally, limit the amount of capital you allocate to penny stocks to mitigate risks further. 4. Budge for losses. Only invest money you can afford to lose. Penny stock investing is akin to gambling. While one could achieve substantial gains, the risk of losing all is equally significant. Conclusion: are penny stocks right for you? Penny stocks can offer enticing prospects for profit, but they come laden with risk that warrants careful consideration. For those who are informed, analytical, and prepared to navigate the intricacies of these investments, penny stocks can serve as a complement to a broader diversified portfolio. Nonetheless, for the average investor, the challenges associated with penny stocks may outweigh the potential gains. Always assess your risk tolerance and investment strategy before diving into this volatile market. With diligent research and thorough forethought, penny stocks can potentially open doors to profitable ventures, albeit with an understanding of their challenges and limitations.